Hey friends, welcome to today's Singapore Market Digest. I'm Wei from the Investing Iguana, and today we're looking at some interesting movements in the Singapore market. The REIT sector has shown mixed performance in their latest earnings reports, with some fascinating stories to unpack. Let's dive into what's happening in our local market, where we're seeing both challenges and opportunities across different property segments. Mapletree Pan Asia Commercial Trust, MPAC. This still MPAC's recent performance tells an interesting story about portfolio restructuring. The Q3 2024 saw DPU drop 9.1% to 0.02, which might sound concerning at first glance. The main factor here was the strategic divestment of Mapletree and Son, a move that temporarily impacted their revenue stream. The strong Singapore dollar also played spoilsport with their overseas returns. But here's the silver lining. The market seems to like MPACT's long-term strategy. Their shares closed up 0.8% at SWAN.19, suggesting investors see value in their portfolio optimization efforts. Think of it as spring cleaning. Sometimes you need to clear out the old to make room for better opportunities. Keppel DC REIT, the digital infrastructure star. Now let's talk about one of the brightest spots in our market, Keppel DC REIT. They've knocked it out of the park with a 30.2% increase in H2 2024 DPU to $0.04902. So this success story isn't just luck, it's about riding the digital wave at the right time. Their expansion into Japan's data center market has proven particularly shrewd, showing how geographic diversification can pay off. They're also benefiting from higher variable rents and strong reversions, which basically means they're getting better deals when renewing leases. At $2.22 per unit, they're showing strong momentum in a sector that's becoming increasingly important in our digital age. SunTec REIT's challenges. SunTec REIT's journey through 2024 reflects the broader challenges in the commercial property sector. Their H2 DPU fell 13.9% to 0.0315, with the full year numbers showing a similar trend. The main culprit, rising financing costs, a common theme across the REIT sector. What makes SunTec interesting is their mixed-use portfolio strategy. While they're facing headwinds, their diverse property mix, office, retail, and convention, provides some cushioning against market volatility. Their unit price stability at 1.21 suggests investors are taking a longer-term view. ESR REIT's strategic shifts. ESR REIT's latest results tell a story of transformation. Their H2 DPU dropped 15.9% to $0.97, but this needs context. They're in the middle of repositioning their portfolio, having sold off non-core assets and decommissioning their Fishery Port Road property. Think of it as taking one step back to take two steps forward. The steady unit price at 0.26 hints at market patience with their strategy. Industrial REITs like ESR are particularly interesting now given Singapore's push towards advanced manufacturing and logistics. OUE REIT's mixed bag. OUE REIT brings some refreshing news to the table with an 8.7% jump in H2 DPU to 0.0113. Their success comes from two main sources: a rock-solid Singapore office portfolio and smart asset enhancement, particularly at Crowne Plaza Changi Airport. The completion of their airport hotel upgrade in December 2023 is perfectly timed with Singapore's tourism recovery. Their stable unit price at $0.30 suggests a good balance between growth and stability. Starhill Global REIT's steady growth. Starhill Global REIT demonstrates the value of geographic diversification. Their 1.1% DPU growth to $0.18 might seem modest, but it's impressive in current market conditions. Their properties in Singapore and Perth are performing well, and they've even gotten a boost from currency movements with the Malaysian Ringgit. Starhill Global REIT's steady growth. Starhill Global REIT demonstrates the value. Looking at the broader market, we're seeing some encouraging signs. The benchmark yields dropped to its lowest since December 11, could signal better days ahead for REITs financing costs. This could be particularly important for REITs currently dealing with higher interest expenses. Remember mates, while some REITs are facing short-term challenges, others are finding innovative ways to grow. The key is understanding each REIT's unique strategy and how they're positioning themselves for the future. That's all for today's Market Digest. Keep swimming towards those financial goals, and I'll see you in the next update.